Hey guys, in this video I'm going to explain how the official cash rate affects our interest rates in Australia. To really understand this, first we have to understand the beast, the RBA, why they exist and what they actually do for us. The RBA, aka the Reserve Bank of Australia, they are a pretty critical part of helping our economy be normal. So what I mean by normal, Australia has a very large middle class. I can confidently say, as a young Australian, doesn't matter what job you're in, you could probably go to a pretty good restaurant in Brisbane right now and order what you want. The divide between the super wealthy and the super poor isn't as relevant in Australia as it is overseas. So they're doing a pretty good job if I talk honestly. I'd come from a middle class family and I can buy property, and I bought property young. Now it's not easy, but it can be done. In some other countries in this planet, you can't do that. So these guys, their job is to understand the pillars of our economy and try and keep it in the middle. As you can all understand, things were getting too crazy. Cars were being bought and sold for more. We had a problem. That's why they have to put the interest rates up to calm us down a little bit so we all don't go crazy and spend too much money and everything comes crashing down. So they're doing the right thing, and I have 100% faith in the RBA. Hope that explains a little bit about why they exist. Now let's talk about how, when they put rates up, how that affects us with our home loan interest rates. When the RBA puts interest rates up, say 3%, which they did in the last 12 months, there is a direct correlation with our home loan rates going up. This is because the money the banks lend to us, they borrow predominantly from the RBA. Yeah, banks can get money from offshore, but predominantly they do get it from the RBA. Now, the same thing happens when rates go down. Rates go down, the money is cheaper from the banks, but generally they don't run down as low as they do in history when the rates are going up. So it is very important to look at your rate, and your mortgage broker should be in contact with you very regularly to make sure you're always on the best deal. Recap, when the RBA put interest rates up, the banks put their interest rates up. When the RBA goes down, they feel like they've got inflation under control and they're trying to get people to spend money, they can pull the same trigger and put rates down. Generally, the banks aren't as fast as putting the interest rates down. That's why it's smart to get a mortgage broker to review your loan at least once a year. So now you should understand how the RBA affects interest rates. Now what I want to teach you is what you can do to prepare yourself when they do go up. A really smart thing I was taught a long time ago is to always pay way more than the minimum repayment. Even with these rising interest rates, if you've got surplus money, please pay your loan off faster. Not only save interest, but you become debt-free quicker. And when the rates go up, it's not as a shock to the system or the lifestyle. Paying your loan off as fast as you can with high repayments is something which will help you build up savings, but also save you interest and pay your loan off faster. Another tip you can do is hemorrhage your bets with a fixed and a variable loan split. So fixed rates, even if rates go up, you're locked in from 1 to 5 years. So you may not want to have your whole loan fixed, but you may want to have half of it. So if rates go up, you're protected. You do lose sometimes some features like offset accounts and redraw, but that's why you may want to have a variable portion. The kind of a fixed loan is when the rates do come lower, you also stay on that higher rate. But hemorrhaging your bets and doing a split loan is what a lot of clients do, just in case rates go up. If you haven't bought a property yet and you're wondering how much you should go, look guys, I would really do a budget and make sure that you can afford the rates to go up 2%, 4%, even 6%, because you never know what's going to happen. So make sure you don't overextend, and maybe you buy a cheaper property just so your lifestyle doesn't change. And let's not all forget, when you do get a home loan in this country, this beautiful country Australia, if the rate is 5%, the banks will put a 3% buffer, meaning that they will only give you the loan if you can afford it if it was 8%. And that's been built in and clearly defined a lot more since the Royal Commission done a few years ago, making sure that if rates go up, most of us should be able to afford it. Of course, if something unforeseen happened, like we lost our job, of which case my next point of advice is to make sure you work with a financial planner who knows your long-term vision, but also opens you up and explains the risks associated now having a mortgage. And one of those risks is something unforeseen happened, like you or your partner got sick. So you probably really want to talk to a planner about income protection, life insurance, trauma, and total disability insurance. These insurances, you should definitely put them on your radar when you buy a property. And on that note, Mad family, I really hope you found this informative. If you like what you're seeing, if you think you're on the same page, please subscribe to Mad. And of course, if you want to buy, reach out. We've got heaps of mortgage brokers and financial planners who would love to help you. No matter where you are in this country, we can help you buy your first house or buy multiple if that's what you like. Thanks. Have a mad day.